Fast Money viewers will know that Doug Kass has been successfully trading the range on the stock market for weeks now, and he very kindly joins us now. Doug, I understand last week you were saying we're at the bottom of the range buy, you're a short-term bull. Do you think we could break out further to the upside?
I'm not so sure we can. I think that the markets and the economy remain, with due respect to your English roots, Simon, in the tale of two cities. We're in a Charles Dickens market. It's the best of times for large corporations that flush in cash. We're operating with the best profit margins in history, but it's the worst of times for the consumer, especially the underemployed.
So what's the trade,
increase
Doug?
in unemployment. I call the next decade the decade of the temporary worker, and I would note that we have only regained 8% of the jobs lost since the end of the Great Recession, while we have regained 75% of the lost GDP. So I think tactically, I'm in agreement with Steve Grasso. A lot of investors were caught offside. They weren't even in the office, and much of this recovery of 55 S&P points since midday Tuesday is probably short covering. I would say that we're neither in the spring of hope nor the winter of despair. We're range bound, and it's going to be a marvelous environment for trading, a less than marvelous environment to invest in. And John, we're back to buying the dips and selling the rest.
Hey Doug, quick question for you. Obviously, we're in agreement on the range bound. This was all about China PMI. This was all about ISM this week. This was all about short covering. Has the administration said anything that has made you think that that is helping the market or hurting the market, or is it just a sort of a side note this week?
I think there are two issues which will create a hiatus and kind of a news warp, which is not going to engender confidence. Firstly, there was an important element of Richard Fisher's speech, the Dallas Fed president, on Wednesday, in which he said that the Fed was unlikely to engage in additional quantitative easing unless it was coupled with fiscal initiative geared towards adding new jobs. And then this morning on CNBC, the School of Economic Advisors came out and said that Christy Romer said that the administration is not considering a sizable fiscal initiative. Couple this with the Republicans, who are gaining strength in terms of their attempt to regain control of the House and the Senate. They're not going to do anything the administration
Let me interrupt,
wants.
Doug.
We're in a difficult environment in that regard, and it could serve to reduce confidence going forward. If you looked at the several of the components of the non-manufacturing ISM were disappointing as it relates particularly to new orders, and the employment component dropped considerably. So these are my concerns.
Yeah, Doug, there is a school of thought, though, that says actually the mood music may change very importantly towards business. When Obama made his speech about Iraq, he said that here on in, the economy was now front and center as far as he was concerned. And there are voices in the market that say, you know, maybe the antagonism will go, maybe the approach to business, the rhetoric, and that actually is in itself a positive. Would you agree to any extent?
Simon, I agree in theory, but given the proximity to the midterm election in November, I would say that the Republicans will likely resist any attempt on the part of the administration. And as I said previously, Christy Romer said the administration is not considering any sizable fiscal initiatives.
Hey, Dougie, this is John, and again, sell the rips, buy the dips.
Hey, John.
Hi, Dougie. I think in addition to the Republican potential sweep that you're citing there, I think that there's also David Rosenberg on Fast last night said that the reason that we had such good economic numbers in terms of retail sales were because of tax cuts municipalities made to bring in shoppers. Well, that's proving that the tax cuts actually do what we hoped that they would do, and I believe that is one of the carrots dangling out there in front of us that could break us to the upside. Do you agree?
The consumer actually has been benefiting from the dramatic increase in refis, but more importantly, the lower interest rates. In fact, according to my numbers, the debt service numbers are back to the levels experienced in the late 1990s, which is a big surprise, allowing the consumer to re-liquefy maybe a year to a year and a half earlier than many of the former bears expected.
Doug, we've got to leave it there. Thank you very much, Doug Kass.